QuickBooks Online 2025. Entering receive payment forms, increasing a clearing account rather than going directly into the checking account, followed by entering deposit forms, decreasing the clearing account back down to zero and increasing the checking account. Why the added step? Stay tuned, that's coming up next. Here we are in our QuickBooks Online Gift Great Guitars 2025 project file we set up in a prior presentation, opening the major financial statement reports like we do every time. And the reports there on the left-hand side. We're under the standard reports in the favorites section, right-clicking on the balance sheet to open a link in a new tab, right-click in the profit and loss to also open a link in a new tab. Let's tab to the middle. Close the hamburger. The range needs to be changed to 010125 tab, 013125 tab. Run it so it can be refreshed. Tab to the right, same process. Ham boogie closed, ranged, changed, 010125 to 013125, and then run to refreshed. All right, let's tab it to the middle. And we've now are entering data input after having set up our company file, getting the fixed assets that we need and the inventory we need to start making sales. So we've made some sales in prior presentations, which has increased the accounts receivable. So noting that when we think about the sales that we make, it will be dependent, of course, on the industry that we are in. If I hit the plus button here, if we are in an industry that we have to do the work first, such as a law firm, CPA firm, a contract kind of business of some kind, we like landscaping, right? We do the work first, then we invoice the client and have to then track the accounts receivable to collect on the accounts receivable, which means the next step would be the receive payment. That's the process that we are in now, as opposed to being at a cash register situation, in which case you're most likely going to get paid, of course, at the point in time you do the work, like in a restaurant or any type of retail store, in which case they might be able to check out themselves, like in grocery stores oftentimes, using, in essence, the sales receipt form. Either of these methods will end up at this point. Let me show you the flow chart. This is the desktop flow chart, but we're on QuickBooks Online. This is just to show the flow of the forms with some nice arrows, which is the same for any kind of accounting system. And notice that if we invoice the client that doesn't have to do with cash, and then we're going to have to receive the payment in some way, shape, or form, whether it be by credit card, cash, or electronic transfer, or whatever. Now, typically at this point in time, it hasn't gone into the checking account yet, because either we've got the cash, or it's in the third party with the credit card company, or it's in some kind of intermediate platform like a Stripe or whatnot before it gets into our bank, unless it was a direct electronic transfer directly into our bank. Similarly, if we made the sale at the cash register, we have the same problem. We get the money at that point, but it's not in the checking account typically because we got paid with cash or with a credit card or something like that. And therefore, we can't usually put these directly into the checking account because we'll run into a matching problem because it's not going to hit our checking account in the same format. This is something that you don't see in textbooks as you should quite often, because the textbook simplifies things down to everything being cash and cash equivalents. So at these points, whether we had an invoice and then a received payment or made the sale at the cash register, from a textbook standpoint, we call it cash or cash equivalent, increasing in essence the checking account at that point in time. But in practice, it's not in the checking account. So why is that a problem? Because if I put it directly into the checking account here, and then I make the deposit at the end of the night, or the deposit comes from the credit card company or whatever, the deposit at the end of the night is not going to match any individual sale. The deposit from the credit card company into our checking account is not going to match every individual sale. It's going to group them together and possibly take a fee out before it hits our checking account. Why is that a problem? Because I need to reconcile the bank account on the bank side with the bank statement to my account, whether I use bank feeds or not. I might use the bank feeds to help me with that process, in other words, but the bank feeds don't eliminate that process, the need for that process. So even if you have bank feeds on, you're gonna end up with a mess if we don't properly group the data input to match what's coming through on the bank side of things, making the bank feed reconciliation process as easy and the complete bank reconciliation process as easy as possible. So that means when we actually make the deposit, we're going to have a larger lump sum, typically combining multiple sales that happen, whether it be cash or credit card or whatnot, than the individual sales. And if we didn't adjust for that, we would have to add up the individual items that we put into the checking account to match the one deposit that was put in by the bank. And it might not work still because they might have taken out a fee, such as in the case of a credit card. So what do we do instead? We take this point in time and we put it into a clearing account, which used to be called undeposited funds for the desktop version, but is now called, I don't know, payments to deposit, I think they call it now. But the point is, it's a cash or cash equivalent type of account. For QuickBooks, it's an other current asset type of account because it has the functionality not of a checking account. It's not going to connect to the bank. And then we're going to take it out of there and put it into the checking account with a deposit form, that deposit grouping matching then what is going to hit the bank, making the reconciliation process easy. Remembering, you might say, well, why do I care about the bank reconciliation process? Every business needs to do bank reconciliations. And I want to point that out because a lot of times, especially with the bank feeds, people throw out these rumors as though AI has eliminated the need for bank reconciliations. The bank reconciliations might be more or less complex depending on the use of bank feeds and how simplified your system is, but in no case is it eliminated. It's not eliminated. Why is it so important? Because it's the second biggest internal control that we have over our system. The first biggest is simply using accounting software like QuickBooks, forcing us to do a double entry accounting system, the double entry accounting system being a huge internal control, meaning assets equal liabilities plus equity. But second to that is reconciling cash, not just because cash is important, but because cash is the lifeblood of the company. If we can say the cash transactions are correct, we can basically have a good internal control that all of our other transactions related to cash are correct. That's the point, right? That's what we want to do. Okay, let's go back on over to QuickBooks. And we're going to go to the first tab over here, and we're going to then go down to our sales. Now, the subledger, we usually don't go into the report. We could go into a report for the subledger breaking out the accounts receivable by customer. In other words, if I went back on over here, this accounts receivable, if I go into it, it's broken out, gives us what we used to call it, or we call in a text, put a GL or general ledger type of account in here called a transaction report broken out by date. That's great, but it's not what we need. We need it broken out by customer. I'm going to go back. We could generate another report getting us to the same balance, breaking it out by customer. But from an internal standpoint, we basically do that internally by going to the tab to the left. In the sales tab, we have multiple different areas where we can look at those open invoices, including closing the hamburger, the all sales. So I could go into all sales and I could filter this by the open invoices here, for example, which also populates here, invoices, boom, open invoices versus overdue and so on. Here's the open invoices. Notice it gives us a total 46,830, which should match here 46,830. So that's basically a subledger report. So I can also go back on over. It's more likely that we'll go into the invoices area and do the similar process and say we want the open invoices, let's say unpaid. So we want the unpaid invoices. So these are the unpaid invoices, and we can also find them, of course, by customer, looking at it by customer, and then these filters breaking out the customer for open invoices. Open invoices here, boom. We're looking in our case for Anderson. So if I go into Anderson, we see then we have the invoice here that's overdue. The next step, of course, would be we're going to receive payment on the invoice. So I could hit this receive payment form, which will automatically populate a receive payment form and the item. The other way I could do it is if I got a payment from the customer, instead of going here, which is most likely what I would do, I could go just to the plus button and say we want to have the next form, receive payment form, and then type in Mr. Anderson, Mr. Anderson, guitars, boom, and then it populates down below. So let's tab through this. So it's a receive payment form. Now, when you see the form type, there's usually one account that's linked to it. And QuickBooks sees it this way as well. QuickBooks sees it as having like one dominant account and then the other side of the transaction. So it's useful for us to see it that way too. In other words, every transaction has at least two accounts affected or more and records in such a way that the double entry accounting system is in balance. In other words, accounting equation, assets equal liabilities plus equity, or debits and credits will be equal. And but QuickBooks usually ties the form to a dominant account of the transaction. So if there's two accounts affected, there's a dominant account. Now with the receive payment form, you would think the dominant account would be the money that you're getting going into the checking account or to the clearing account because you received a payment. But really the receive payment form is only used when you decrease accounts receivable. So really the thing that should come to your mind first with the receive payment form is that it decreases accounts receivable. Even if you didn't have an invoice to tie it to, it would come up with a negative or credit balance in accounts receivable, right? So if I tab through this, we're going to say we want this on 01/25/25, let's say, and then we can choose the payment. Now, we can do cash, check. We could add another one, which would be an electronic transfer, for example. If we got paid from an electronic transfer, note that we had an invoice. This is the invoice down here. And then we expect to get paid. How did the client get the invoice? Most likely with an email. In practice, when we email the client, we could give the client different options to pay us, which might include things like these different payment options. But the main ones would be they could give us an electronic transfer not using a QuickBooks checking account, but our normal checking account like Bank of America or something. And in which case, we're not really able to link the invoice transaction directly to receive payment, but it is still connected in the bank feeds. And therefore, when I get the payment through the bank feeds, I'm going to be able to basically see the electronic transfer. We could have an Intuit account, in which case, if they pay us with an electronic transfer through the Intuit account of our checking account, not only is it connected to the bank feeds, but it has the added connectability to possibly record the transaction automatically at that point in time, which is cool. If it's a credit card type of account, then the credit card company is going to be the intermediary. So we're going to get the payment, but then we're going to have to record it into a clearing account when we get paid from the client, because the clearing account is most likely going to group it with other deposits. And then we could get cash. If we got cash, it goes into our cash drawer and not into the bank account. So for our purposes, I'm just going to pretend it's cash right now. And then we could have a reference number if it was like a check or something. And we have the same issue here that we saw when we did this with I think with the sales receipt form. I'm not going to put it directly into the checking account, but put it into the payment to deposit. Now again, if you only tell your client, I want you to pay me through electronic transfer or check, then you might put it directly into the checking account. Why? Because when it hits the checking account, it's going to be in the same grouping as the invoice. They're not going to combine multiple sales together. But if you combine payments, if you tell the client, you can pay me with a credit card, you can pay me with an electronic transfer, you can pay me with cash, with a check, I don't care, just pay me, then you might get an electronic transfer, or you might get something that's going to have this grouping problem, in which case I would always use the clearing account, because I wouldn't want to set up my forms that I sometimes use the clearing account, because then you're going to mess it up sometimes, right? So either I would say your system should be, I always use the clearing account because I allow some payments that are going to need it, or I have a system where I restrict my clients to only pay me through a way where I can directly put it into the checking account, which you might do because you might say, I'm not going to accept credit cards. Why would I accept a credit card? The credit card charges me money. And so that might piss some people off. It might make the clients mad that want to pay you by credit card, but you're like, dude, you could just give me an electronic transfer and therefore we don't have to pay the credit card company or something, right? So you might restrict it in that way to give you the cheapest payment option, or the inverse would be you give your client as many options as you can, making them as happy as possible to pay you with whatever their preferred, payment system is. All right, so then the other kind of thing I just want to point out is that if you put this directly into the checking account, that means that this is going to show up in the detail in the checking account as a received payment form, looking like a deposit, which is a little wonky as well, because normally it's not a big deal. But if I wanted to sort my checking account transaction detail, the general ledger, by increases, I would like them to all be deposits for the most part. So the fact that I also have to go into the received payment forms as a filter, not a big deal if you remember, but it does make things a little bit more complex just in the data. All right, so then we have down here, we only have one invoice, so I'm going to check off that invoice. So the received payment will almost always be tied to an invoice in a normal kind of process, although you can imagine a situation where you got paid first, like we took a down payment for a guitar, in which case I wouldn't have an invoice to apply it to, in which case it would still decrease accounts receivable, making a negative accounts receivable, what you might know as a credit balance in the customer account. All right, so we could put a partial amount in here, but I'm going to imagine we get the full payment. We could clear it, cancel it, print it if we needed to. You don't normally have to print these, but you might provide this to a client and therefore want to print it. Clear the payment. We can save it, save and close. And if you wanted to send it, again, you might not always send this as you would with an invoice, but you might send it sometimes as an acknowledgement of the receipt of the payment. We're not going to do it though. We're going to save it and close it. What's this going to do when we record it? It's going to decrease the accounts receivable. It's going to increase the clearing account of payments to deposit, and it's going to impact the subledger for the customer for the accounts receivable, which was Mr. Anderson. Save and close. Let's check it out. Stop talking. You got too much talk, man. I want to see some action around here. Hate talkers. I hate talkers, man. Got nothing. Okay, I'm doing it. We're going into the action. So we're going to go down. We made then. Wait, it didn't go into the checking account. That's the wrong account. See, if you weren't talking so much, you'd be able to know what you're doing. Okay, quiet. I need to think. Quiet. It's in the payment to deposit. It's in the payment to deposit, the clearing account, in the others section. So there's our payment type of form. Notice that the name is changed. It's kind of weird because they sometimes call it a payment form and then a receive payment form. So here it's a payment form in the transaction detail. Notice that if I put this directly into the checking account, it would be in there as an increase to the checking account, right? Which is a little weird if it were in the checking account. So then I'm going to go into it, and there is our actual form. I can link it to the invoice if I wanted to get to the detail of what invoice it was paying off, closing that back out, going back. The other side is going to the accounts receivable, the pirate account, the ARG pirate account. I've got pirates in my neighborhood. I wish they would just, they're adopting the wrong things, man. They should adopt the nice pirate haps and not the theftery and thievery and thuggery. But whatever. People are crazy. Receive payments. We're going to close this out. All right. And then let's go back up and go back. And then the subledger is going to be impacted for the accounts receivable. So 43,207.50. If I go to the first tab, let's just look at that subledger once again by going to the all sales. And we can sort this out now for the open invoices. That one is missing now. And now we've got 43,207.50. Ties out here. We can search that by invoice this way as well. So these are the open invoices. It's funny that it doesn't give us a total on the open invoices, but it does on the all sales. That's kind of interesting. And then notice that I could then say, I want to see the ones that were paid, right? So these are the ones that have been paid now, but they haven't necessarily gone into the checking account. So we have ones that are paid but not deposited. This one has been paid and not yet deposited. The ones that have been deposited are going to be these items which have been completely gone through the system. We can also see that in the customer data. So in the customer with Mr. Anderson, We now have the invoice has been marked off as paid. If I go into that invoice, not that way, I want to go into it with the edit. Then, of course, we can check it out this way. So it says it's been paid in full here. So there we have that. I'm going to close this out. And then, of course, if I look at the payment, here's the payment. Check that out. It gives us a little running thing. But let's go into the edit, and that'll give us the link to the invoice. So I could go back to the invoice this way. So it's all linked up beautifully. So let's close that out. All right, otra vez. Let's do it again. Let's do it again so we can get this down. Repetition. Repetition is the key to success. So we're going to do this one, Eric Music. So in the all sales, we're looking at Eric Music is the next one we'll do it for. We can also see it in the invoice tab. You will recall if I was to now look at the unpaid invoices for Eric Music. And then, of course, we can see it in the customers sorting by open invoices. Once again, going into Eric Music for the open invoice. So there's the open invoice. We can see thusly. We can go into the receive payment form. There's the receive payment form. Remembering the thing that pops into my mind when I hear receive payment is that I'm going to get paid normally, but from a QuickBooks standpoint, it's going to decrease the accounts receivable. It's going to decrease the accounts receivable. For Eric Music, we're going to say this happened on 125. Once again, I'm just going to choose cash as the payment option so that we can group it together, but you have the same issue if it was a credit card or if it went through Stripe or something like that of this grouping problem. We're going to put it into the payments to deposit, which used to be called the undeposited funds, but the QuickBooks Online team has to change things because they have to be relevant. They have to justify their job over there. So that's why they change the names of stuff and they move everything around and they try to have hip, cool names instead of professional names, but they're getting better, whatever. They're doing good. I don't mean to be overly critical. But in any case, what's this going to do? It's going to decrease the accounts receivable. It's going to increase the payments to deposit, to accounts impacted, keeping the accounting equation in balance, the debits equaling the credits, double entry accounting system working, and the subledger for accounts receivable going to be impacted by customer for Eric Music. Let's go ahead and save it and close it, and then we'll check that one out. Go into the balance sheet, same process. Let's run it to refresh it. We have the A to the R, the pirate account. Pirate account, we're going to go into here, but they're nice pirates. They're not like the mean pirates that steal stuff all the time. These are nice pirates. We're going to then go down to, we wouldn't associate them as with clients if they were the mean pirates. And then we're going to say that it goes into, the other one goes into the payment to deposit account. Payment to deposit account. Boom, Eric Music. So there is that one and the subledger impacted. Let's go back. Notice that there's no impact, by the way. If I go to the income statement, nothing's happening here, even though I'm getting money. Why? Because on the accrual system, we've recorded the money when we recorded the accounts receivable. You might say, why do we do it that way? I want to be on a cash-based system because it would be easier. You can't be on a cash-based system if you have to track accounts receivable because the accounts receivable is an accrual account. There's no real way around it, you see. I just want to point that out because sometimes people think like that shouldn't be that way. They're saying, hey, I'm not going to, this is the argument. They say, this is stupid. You're recording revenue before you get the money. I don't do that. If I don't have the money in my hand, I'm not recording the revenue. I get that. It's legitimate. That's a legitimate argument. But logistically, using a double entry accounting system in QuickBooks, you can't get the accounts receivable on the books without recording the revenue at the point in time you receive it. So you could, if you wanted to be a conservative in terms of, I didn't get the money, so I don't count this as revenue. You could switch this like to a cash-based system to see the revenue without the money that you haven't yet received yet. But again, you can't, if you have to track the revenue, if you got to send out Rocky to try to collect on the money, then you're going to have to track the accounts receivable, and you're going to have to use an accrual-based system for the most part, unless you track it outside of QuickBooks or something, which it would be more difficult. Anyway, let's go to the first tab. So now we can see if we go into the All Sales tab, then we now have the open invoices, 2 open invoices left. If I go into and notice that $12,757.50 should match what's on the balance sheet. $12,757.50, MUI B to the N, BN. Let's go to the invoices. Here's the open invoices, the ones that have been paid but not deposited. These are 2 that we got paid on that aren't in the checking account yet. Therefore, these 2 will add up to the balance that's on the balance sheet, the payments to be deposited, the clearing account. And then, of course, if I go into the customer for Eric Music, we go into there, and so now we have then the payment that has been made, and the invoice is now paid. All right, so now let's say we need to put this stuff into the bank. Let's go to the balance sheet. So now we have the money in the payments to deposit. Now, we imagine this happened with cash, but you can logistically imagine a similar process if it went through a third-party institution like a credit card or like a Stripe or something like that. So in other words, with the cash payment, what do we imagine happened here? People came in and they paid us off with cash. We took that cash, we put it into our cash register, and we recorded the received payment, but the money, although we have it, and it's in cash and cash equivalents on a normal balance sheet, it's not yet in the checking account. Therefore, at the end of the night, we're going to arm up because there's pirates out there. There's real pirates. There's like the mean pirates out there. So we arm up, and then we go to the bank, and we deposit it into the bank, and we do it in a lump sum type of deposit. So that means when it goes into the checking account, it's going to be in there as this full $37,072.50 instead of the 2 amounts that we have received. And that means that when that deposit comes from the bank into our books with the bank feeds, and or when we reconcile with the bank reconciliation, we'll be able to match it out to the checking account when I deposit it in that lump sum. Notice that if I put these 2 amounts directly into the checking account, then when I physically make the deposit of $34,72.50, it will not tie out to what's in our checking account, even though you might say, well, it still doesn't matter because I can just add up those 2 amounts, which will be the same ending balance. That's correct, but it won't be easy for me to tie out the balance to the amount that comes through with the bank feeds on the bank side of things, or when I do the bank reconciliation, because the system won't be able to recognize the 2 different dollar amounts. The system won't be able to say, oh, I need to add these 2 things up to match that deposit that was in the system, right? We don't want to have to do that because that's going to make the system not efficient, right? We're not going to be able to reconcile easily. So if you find yourself doing that when you do the bank reconciliation, meaning you're going to have to go through the bank feed data and add up, multiple deposits on our side to match what's on the bank, it's most likely would be better if you used a clearing account in some way. Similarly, if the money went through a credit card, they're not going to take every payment in the credit card payment coming from a customer and deposit it individually into your account. They're going to group it together, and they will most likely take a fee before you get the money. So that means if it goes through the credit card, you're going to end up with a real problem, right? It's going to be worse because now you can't even add up all the payments that you recorded into the checking account because they're not going to tie out to the amount that was deposited that went through the credit card because the credit card took out a fee. So you have to put in the clearing account in some way. That's the idea. All right, so let's go to the first tab. How do we get to that? We go to the plus button, and we're going to say that we're going to enter a deposit, bank deposit form. And QuickBooks has this pretty cool functionality. It's going to be going out of the checking account. So when I see the deposit form, what's the main account? There's 2 accounts affected all the time. What's the main account? The checking account. It's going to go up. That's what a deposit form does. We're going to do it on 125.25. So that is good. And so then the other side of the deposit form, when I use these items here, is always going to be undeposited funds. And that's when I would typically use the deposit form. Whereas if I make the deposit directly using an account, then it's going to impact some other account. So typically in my mind, what I would do is usually when a deposit comes through, if it's a simple deposit, I would use the bank feeds. If it was a deposit from me for example, or something like that, I'd wait till it clears the bank and use the bank feeds to record it possibly. Or if I'm not using the bank feeds, then I would go into the register to record the deposit form in a more simplified fashion by going to the chart of accounts and then the register and just assign the account. But if it's going through funds to be deposited, because they are deposits from the client, either from the received payment forms or the sales receipts, then I would use the deposit form because the system has this functionality allowing me to do it. And that means that the other side of the deposit will also basically be fixed. Both sides are basically fixed. What does the deposit form do when I use this part of the deposit form? It increases the checking account and it decreases the clearing account deposits funds to be deposited. In other words, this 3472.50 matches what's in the clearing account, 3472.50. All right, so let's go back on over. We'll just check those two off. Boom, what's it going to do? Increase the checking account, 3472.50, instead of each of these individually, making it match what actually physically goes into the checking account, allowing for the reconciliation to be as easy as possible. The other side, decreasing the clearing account, which QuickBooks doesn't do with one lump sum, but rather breaks out into these two individual amounts, which is good because that allows us to tick and tie the clearing account, which should go back down to zero more easily. Let's check it out. I'll show you what I mean. Let's save it and close it. Go to the balance sheet, run it to refresh it. In the balance sheet, we're going to just go into that and check it out. So we have a deposit in the balance sheet of the full amount, $20,500. So that was the wrong one. Let's close this out. Donde, it didn't show up. Let's go back. It didn't refresh. QuickBooks, I told you to refresh. You're giving me rotten reports. These are old. They're moldy. I can see the mold on it, and you served it up to me like that. I am disgusted. I do not eat moldy report. I don't use molded reports. So it went in there at the 3472.50, 3472.50, the full amount. So that's good because it matches what's going to be on the bank statement. Let's go back. The other side then, if I go into payments to deposit, is now at zero, but QuickBooks still puts it in there because there was activity in it. So let's go into it. That's cool because it lets us drill down on it. And it has then the deposits on 125. Where's the deposit? Where is it? Oh, there it is. I thought they messed it up again. So it put it in there two amounts, even though that happened on the same deposit form that happened on 125. That's because it allows us to tick and tie. So if this amount doesn't go down to zero, there is a problem. And it's either we're holding on to money that hasn't gone into the bank yet, or the clearing or the credit card company hasn't yet given us our money yet or something, or there's something happened with the recording. So we can easily tick and tie out the increases and decreases because QuickBooks didn't deposit them together. This is one area that QuickBooks does better than most of their rivals, including, I believe Xero doesn't do this quite as good, which is their main online rival. Xero has some benefits to it as well. I'm not paid by either one of them. But QuickBooks has this attention to detail on like the report forms, which are almost too much detailed sometimes, and this kind of thing where they have it correctly broken out, which makes most sense here, and grouped together on the bank side. I think they do that better than competitors. All right. One other thing I want to point out here is if I go into this checking account and we go down to the deposit, what if it came through the credit card company and they charged us a fee? Then we can add the account down here called like bank fees or something, bank charges, and then we can put in the fee. So that would decrease the amount that finally hit to our checking account. That's how you deal with those fees that might happen if you have a financial institution in the middle, like the credit card. Let's close that out. I'm not going to save it. Do you want to leave without saving? Yes, I do. And let's go back and let's go to the first tab and just see what happened here. So if I go to the all sales, we can see now that we still have our open invoices here. Let's go to the invoices tab, and we have the ones that were paid. These are all the ones that have been paid. And then I have the paid but not deposited. None of them have not been deposited because all the payments that we have received, we have now put into the checking account. And the ones that have been deposited are now all the ones that we got paid have been deposited. Let's go into the customers. And on the customer side of things, again, for like Eric Music, for example, we've got our payment here that has been basically closed. Transaction details, boom, we have received the cash. All right, so everything is linked out. All right, so now let's go and just open up the trial. This is where we stand. Here's our balance sheet. Let's run it to refresh it, make sure we're dealing with fresh stuff. I don't deal with moldy reports. Moldy reports, I hate to be snobby. I'm a bit of a report snob, but I only deal with fresh reports. Aged is for wine, fresh is for reports and bread. Let's go to the tab to the left. We're going to open up the hamburger and go down to the reports, and we'll type in the trusty trial balance. Trial balance. Close up the ham boogie. Run it for 010125 to 013125, run it to refresh it. So this is just the balance sheet on top of the income statement. If your numbers tie out to these numbers, that's great. If not, try changing the date range, increase in the date range to include your current date that you are in. See if that changes the numbers. If it does, drill down on the changed number to the source document and then change the date to before January 31st, 2025. See if that fixes the problem. If it doesn't, then we will take a look at the transaction detail reports at the end of the first month of data input. Noting that this is just the balance sheet on top of the income statement. So the assets are up top. Cash is an asset. Accounts receivable is an asset. Inventory is an asset. Investments is an asset. Payments to deposit has been cleared out. Furniture and fixture, fixed asset. And then the weird one, the contra asset of the accumulated depreciation. Then the liabilities. Accounts payable is the first one. Visa, the sales tax, California Department, the loan, and then the equity. We only have the owner's equity here, and we have the investments, owner's investment and owner's equity, that being equivalent to retained earnings if it was a corporation, and then the income statement, income, service income, and product income versus the expenses, of which at this point we only have cost of goods sold, the cost of the inventory, noting that if I took this plus this minus this, that would give us the balance on the income statement of the 14,815. If I increased the income statement date range to 2025, it would clear out. Nothing would be here on the balance sheet. If I increased, to 2026, the report to 2026, this net income, 14,815, would roll into owner's equity, equivalent to retained earnings account. If I went to the trial balance and changed this to 2026, it would close out the income statement accounts and put the net balance into the owner's equity, equivalent to retained earnings if it was a corporation. That's how the double entry accounting system works. That's how the assets equal liabilities plus equity remains in balance even as we reset the odometer on the income statement, the temporary accounts, because they're part of equity, and simply close out into equity when we reset things, which with QuickBooks we only do on a yearly basis. QuickBooks doing it automatically on a yearly basis, although conceptually you can imagine doing it on a monthly basis and whatnot. It's just that you would have to do it, you'd have to kind of export it and do it manually if you want to think about that from a month-to-month basis. Okay.